Hello students, welcome to the series on fundamentals of insurance. The topic of this lecture is insurance and economic development. The objectives of this lecture are to discuss the developmental phase of insurance sector in India, to discuss the ways through which the insurance sector contributes to the economic development, and to discuss the contribution of the insurance sector to the Indian economy. It is a fact that insurance encourages investment, which is necessary for the growth of nation's economy. We know that investment is not possible without savings. Insurance companies mobilize the saving of middle and lower income groups in India. The Insurance Act protects the savings by encouraging the investment of the funds in safe avenues like government bonds. Life Insurance Corporation of India or LIC contributes in this way to the economic development of India. While discussing the need and purpose of insurance, we came to know that insurance contributes to the nation's economy. Insurance not only provides the safety and security to the individuals, but to their property and their dependents. But it promotes the growth of Indian economy by encouraging saving. Safety and security of life and property brings about mental peace to the individual, and he then concentrates on his work with an open mind. This increases his efficiency and ultimately help in betterment of the economy. It is an understood fact that if the economy is growing, then the society will experience high standard of living and prosperity. Let us now discuss the developmental phase of insurance sector in India. The first insurance company or the Oriental Life Insurance Company was established in Calcutta in the year 1818. After that, Triton Insurance Company, which was the major insurance company, was established in the year 1850. The major shareholders in these companies were the Britishers, and these companies were mainly in the life insurance business, which only covered the urban areas in India. The first legislation to regulate the insurance sector in India was Indian Life Assurance Companies Act 1912. But later the Insurance Act 1938 came into existence. This act was a legislation for both life and general insurance. The provisions under this act are statutory deposits and registration of insurers, periodical returns to government, fixation of commission rates and prohibition of rebating out of commission on premiums, and licensing of agents. Claim settlement was a problem during the partition period, that is between the years 1940 to 1950. The Qazi Jahangir Committee was appointed to amend the Insurance Act 1938 in the year 1950. The changes suggested by this committee were limitation on expenses of management, limitation of commission payable to principal agents and ordinary agents, establishment of the Insurance Association of India, and tariff committees in Bombay, Delhi, Calcutta and Madras. In order to check the concentration of wealth in few hands, there was an urge to nationalize the insurance and banking business. The life insurance was nationalized by the Life Insurance Corporation Act 1956. Life Insurance Corporation of India was the product of this act. LIC later on entered in general insurance business in the year 1964. The general insurance business was also taken over by the government by enacting the General Insurance Business Nationalization Act 1972. In total, there were 107 general insurance companies. These companies functioned through 4 companies, namely National Insurance Company Limited, Calcutta, New India Assurance Company Limited, Bombay, Oriental Fire and General Insurance Company Limited, New Delhi. Later on, it was named as the Oriental Insurance Company Limited, and the United India Insurance Company Limited, Madras. As discussed in the last lecture, these were the 4 companies. The central and state government departments also provided insurance such as postal insurance, sickness insurance, pension, deposit insurance and export credit related insurance. Deposit Insurance and Credit Guarantee Corporation was established and Export Credit Guarantee Corporation of India was also established. The Government of India in the era of liberalization established a committee, and this committee was known as Committee on Reforms in the Insurance Sector. This committee was known as the Malhotra Committee. The major tasks of this committee were to assess strength and weakness of insurance sector in terms of providing high quality services to the public and to serve as an effective instrument for mobilization of financial resources for development. The other tasks of this committee were to review the then existing structure of regulation and supervision of insurance sector and to suggest reforms for strengthening and modernizing regulatory system in tune with the changing economic development. This committee submitted its report in the year 1994 with the recommendations like establishment of an independent regulatory authority similar to Securities and Exchange Board of India or SEBI, allowing private sector to enter the insurance field, improvement of the commission structure for agents to make it effective instrument for procuring business, especially in rural, personal and non-obligatory lines of business. Insurance plans for economically backward sections and appointment of institutional agents, and setting up of an institution of professional surveyors or loss assessors. The other recommendations were functioning of Tariff Advisory Committee or TAC as a separate statutory body and investment on the pattern laid down in section 27 of the Act. The other recommendations were marketing of life insurance to relatively weaker section of the society and specified portion of business in rural area. Provisions for cooperative societies for transacting life insurance business in different states of India and the requirement of specific portion of the general business and as rural non-traditional business to be taken by the new entrants and welfare oriented scheme of general insurance. The other recommendations like technology driven operation of General Insurance Corporation of India or GIC and to exclusively function as a reinsurer and to cease to be the holding company. Introduction of unit linked pension plans by the insurance companies and restructuring of the insurance industry. Because of the recommendations by the Malhotra Committee, the insurance sector made tremendous development in India. Committee on Reforms in Insurance Sector set up under the former Governor of Reserve Bank of India, Mr. R. N. Malhotra, was set up in the year 1993. Committee submitted the report and recommended on topics as industry restructure, regulatory framework, intermediaries and restructuring of existing players in the year 1994. Announcement to set up of Insurance Regulatory Authority or IRA was made in the year 1995. Power of Controller of Insurance transferred to Interim Insurance Regulatory Authority in January 1996. IRA was proposed to be statutory body. Health insurance decided to open for private sector in the budget of the year 1996. The draft bill Insurance Regulatory and Development Authority or IRDA was established in the year 1996 and was submitted to Lok Sabha but was withdrawn in wake of opposition in Parliament in December 1996. IRDA bill finally got passed by both the houses and got approval of President of India in the year 1999 and 2000. First set of licenses was issued to private insurance company on 23rd October year 2000 with the condition that the private players can open insurance companies in India only in partnership. There should be an Indian partner with maximum 26% equity. Let us discuss the various ways through which the insurance sector contributes to the economic development of the country. These various ways are savings mobilization, investment through development of capital markets, reform in pension system, economic contribution by the life insurance sector, development in life insurance markets, and stimulation of the life insurance sector by the government. Let us discuss savings mobilization. Through life insurance, persons with low income can invest effectively for the long term. Simple life insurance and savings contracts can be purchased with small amounts on regular basis, and insurance companies can accumulate large amount of money from the people. Insurance companies then invest this money collected from the individuals for the betterment of the economy. In life insurance, there is regular or contractual nature to the payment of premium by consumers, so the level and stability of personal saving is increased. Through this, the insurance companies encourage individuals to save. Despite the occasional criticism of pressure selling, the insurance companies create effective sales and marketing techniques which help in the growth of the insurance business in India. The second point is investment through development of capital markets. Through premiums paid by the policy holders, there is a continuous transmission of savings into the economy. The capital market plays an important role in this process. Life insurance companies mobilizes the saving and invest it in the capital market. Savings generated through life insurance and private pension contracts and the development of a domestic capital market is a two-way process. This is because life insurance and private pension contracts involve a voluntary decision to save on the part of the customers. If the investment opportunities available to insurance companies in the capital market are not attractive, then the customers may not save through this option. So, there should be a dynamic interaction process for the development of saving through life insurance and the development of capital market to assist each other. Life insurance companies should play a risk absorption role in the capital market as underwriters of new equity and bond issues. This can be done through guaranteeing the placement of issues and placing a floor on the issue price. This will result in supply of new issues in the capital market. The third point is reform in pension system. It is a fact that government is unable to justify to voters the higher taxes or more state borrowing necessary to support the pension system. Private sector has been encouraged in the insurance sector to resolve the problem by unfolding the state pensions. Due to aging population and high public expectation with the rising standard of living. But a balance between the state and private pension provision is required because of the need of fiscal prudence due to pressure from the IMF or the World Bank. The life insurance companies are encouraged for this task because of the experience in the long-term saving business and development of tested pension products like personal pension and group pensions. which are usually organized through an employer or professional association. The drawback of state pension scheme is that individuals who are self-employed are often inadequately covered. This is due to non-compliance by individuals or to the black economy or due to the difficulty of collection by the social security agencies, especially in rural communities. Life insurance companies operate through agent and brokers network and their offices, so they have a more effective collection system. Let us continue this lecture with the various ways through which insurance sector contributes to the economic development of the country. The next point is economic contribution by the life insurance sector. The private sector through capital market makes the saving available in the form of equity or debt capital to the various sectors like manufacturing, agriculture, energy, trading enterprises, etc., and thus contributes to the economy of the nation. New companies are set up and finance is made available for the existing companies to increase their capital expenditure in new plant, equipment, etc. Through life insurance, the saving can be tied up for a long time and made available for capital expenditure decisions that increase the profit for the organization. This supports the banking system as banks can only provide short-term finance to manufacturing and other enterprises because their deposits are of short term. These long-term savings generated by life insurance companies is made available to the government to encourage fund improvement in the infrastructure to attract the foreign companies as well as the private sector. These capital expenditure decisions by the private sector and the government increases the level of employment, increases the export potential of the country, and the balance of payment situation gets better, as well as foreign exchange holdings get improved and standard of living increases in the country. Saving encourages individual to consume less, which helps in lowering the inflation pressure. The next point is development in life insurance markets. Life insurance market take time to develop as compared to banks and non-life insurance companies, as highlighted by Gary Dickinson in his article Encouraging a Dynamic Life Insurance Industry, Economic Benefits and Policy Issues. As GDP per head within an economy remains low, spending on life insurance remains low. But as GDP per head increases beyond a certain threshold, spending of life insurance begin to increase. But it is very true that at a very high level of GDP per head, the rate of acceleration tends to slow down, partly due to the fact that wealthier economies tend to have older population who begin to draw down their saving during retirement. The change in life insurance products and wide scope of life insurance market depends on the economic, political and the cultural factors. Life insurance products depend on the primary aim of insurance protection to a greater saving role like saving for retirement purpose and the product being sold on an individual or group basis to more complex products sold mainly on the individual basis. We are discussing the various ways through which the insurance sector contributes to the economic development, and the last point in this category is stimulation of life insurance sector by the government. Government must take some measures to stimulate the growth of its national life insurance industry like regulation and supervision. The government should have an efficient and effective as well as flexible system of regulation and supervision to provide confidence to the public through insurance sector. The insolvency of one life insurance company can shake the confidence of public, and the public will be skeptical towards the life insurance sector as a whole. The government should also supervise the marketing schemes of the life insurance companies. Agents, brokers, and other insurance intermediaries advising and selling to the public must meet the minimum competence and ethical standards as set up by the government. Professional education standards for agents and brokers should be encouraged. Insurance regulation by the government should not be too restrictive in case of insurance company funds and life and pension products which are offered by the life insurance companies. Consumers need to have a choice. Restriction on the insurance company funds by the government can reduce the rate of return that policy holders earn on their savings as compared to other long-term saving alternatives. The government should not impose undue restriction on investment policy and pension product development. There should be a balance between ensuring sound investment policies of life insurance companies which reflect the capital market and allowing insurance companies to earn competitive rate of return on the savings of policy holders. The other measures for stimulation of life insurance sector by the government is tax incentive. Government grants tax incentive to encourage long-term savings, especially for products linked for retirement purposes. Tax investment can be in terms of income tax, deductible on premiums paid, favorable tax treatment on policy proceeds at the termination of life insurance contract, and the tax treatment of life insurance company itself. According to Gary Dickinson in his article Encouraging a Dynamic Life Insurance Industry, Economic Benefits and Policy Issues, these tax subsidies where they exist are viewed by governments as a good investment for the taxpayers since the taxes foregone are expected to be more than offset by lower tax support needed in the future. The other measure for stimulation of the life insurance sector by the government is liberalizing the domestic market. The growth of life insurance markets will be fast if they are open for foreign competition. Such competition results in new products, new marketing strategies and distribution techniques, as well as new methods of management and organization. Efficient management of life insurance is dependent on the effective IT system. Foreign life insurance companies, before entering the other country, analyzes the profitability of the investment on the basis of establishment of new local life insurance company and a takeover of local company or joint venture with a local partner. The government must decide about the balance between the domestic and foreign ownership in the short term, and this is determined by the market forces in the long term. The other measure for stimulation of life insurance sector by the government is recognizing a partnership role in pension reform. Governments can encourage the growth of life insurance industry by being its long-term partner in pension provision. Government may transfer some of its responsibilities to the private sector and make the life insurance industry its key partner. The problem in our country is that before the policy is approved by the government, the elections take place and the government itself changes. So, a long-term strategy will encourage investment by the life insurance industry, which may either be domestic owned or foreign owned. The government can stimulate the growth of life insurance sector by encouraging personal saving and financial planning through education. This can be done through teaching curricula in schools and universities. Public awareness can be effectively carried with the local insurance industry through sponsoring educational material. In the era of privatization, the insurance sector has taken fast moves and thus contributed to the economic development of India. It is important to make investment in core areas. These investments are usually through long-term savings of the people. These people are specifically the middle and lower income groups. One of the important source of long-term saving is life insurance. Life insurance helps in creation of wealth and it provides safety and security to the insured as well as his dependents. In India, social security system is not very effective. So, insurance provides pension benefits to the retired persons. Government supports insurance by providing premium tax exemption to the insured on certain terms and conditions. Today, insurance penetration stands at 3 to 4% and the latent potential is immense. Several industry players have been attempting to enhance financial literacy levels in order to increase penetration level and mobilize savings. Prospective policy holders purchase life insurance products with a view to provide for financial security of their family and dependents as well as to create a corpus for specific events in life, besides getting the tax deduction on premium paid. It would therefore be beneficial if the premium paid for keeping in force the life insurance policies are made eligible for a specific deduction on the standalone basis up to the limit of rupees 50,000 as highlighted in the article Life Insurance and Economic Development, the Growth Nexus in Economic Times by Sandeep Bakshi dated 24th February 2011. The government should support the insurance industry by providing budgetary measure. Government should also promote the health insurance. Deduction for health insurance premium paid up to rupees 50,000 would help in ensuring the policy holders their unforeseen health related expenses adequately covered. As per the article Life Insurance and Economic Development, the Growth Nexus in Economic Times by Sandeep Bakshi dated 24th February 2011, with regard to the tax on maturity proceeds of life insurance policy, the current legislation provides that these will be tax free in the policy holder's hand in case the premium paid does not exceed 20% of the sum assured. The Insurance Regulatory and Development Authority or IRDA anyway mandates regulations covering minimum sum assured under unit linked insurance plans or ULIPs. Also, all products require prior approval of the IRDA to ensure these meet the policy holders' interests. The government must decide on the ratio to determine the eventual tax-free status of the maturity proceeds instead of codifying the same in the Income Tax Act. Pension and annuities provided by the insurance companies have gained the confidence of the customers and are highly acceptable by the customers in India. It is because that the savings of the customers are invested to give them proper returns at the time of retirement and even after that. But if the amount is subject to tax at the time of maturity, then the insured will not be able to bear this burden during or after the retirement. Government should take measures that make the annuity tax free to gain the confidence of the insured. The government support is very important for the advancement and development in the insurance sector. It should always be kept in mind that the insurance sector contributes to the economic development of India. Thank you.